Hey, what's up, everybody? I'm going to bring you the best of the best tax planning tips and strategies here at the end of 2020. Why am I doing this now? Well, that's because now's the time to do tax planning. It's actually the latest you can do it. You can be doing it all throughout the year. But when December 31 hits, you roll into January 1, you lose the ability to take advantage of the large majority of these strategies and tips. So you want to be thinking about it now, because when you sit down in February, March, or April to do your tax return and you go, hey, can I do this? Can I take this deduction? Can I get this credit? It's going to be too late to qualify for it. You need to have already taken action during 2020, not when you're preparing the return next year. Side note here is, why don't you see any advertisements? I mean, the big box chains, the tax software, they should be running advertisements right now about helping you get your maximum refund, because now is when you can actually take steps. Then when they're running those ads, it's just a marketing gimmick to get you to choose them over someone else, because all their software does the same thing. All the tax preparers do the same thing. It's a basic math problem. But that's a side note. I have another video for that. So what are your year-end best of the best tax planning tips and strategies? We're going to run through this list fairly quickly. If you have any questions about these, do a Google search. If you're concerned about the source that you're getting when you do a Google search, please reach out to me. I'd love to help you understand these better if you qualify for them, because again, this is going to be pretty quick rundown, and you need to make sure that you actually qualify for these things. The first one is bunching charitable gifts. The whole purpose of this is because they increase the itemized deduction, because they increase the standard deduction, very few people are now itemizing. Well, by bunching your charitable gifts into a single year, you can perhaps exceed that threshold and get some additional benefit. A donor advised fund is a great tool to utilize for that, so that's another thing that you can search and read more about. Charitable giving for everyone. Congress passed an above the line deduction for charitable giving. Now, all that means is you don't have to itemize in order to deduct some of your charitable gifts. Now, they failed here, in my opinion, because the dollar amount is so low. They only made it $300. I think there might be talk of increasing that. But every tax dollar saved is another dollar back in your pocket. So you might as well take it since you qualify for it. You can get a $300 deduction for cash contributions to a qualified charity. Now, donating appreciated assets. This is a great strategy because by donating appreciated assets, you get a charitable contribution for the fair market value of what that asset is worth, but you don't have to report the gains on that appreciated asset on your tax return, and therefore you can skip out on paying tax on those gains forever by giving those appreciated assets to a qualified charity. The home office deduction. A big part of tax planning is not just taking every deduction or credit that you qualify to minimize your taxes, but it's also paying the right amount of tax so that you save in potential penalties and interest. To do something now to increase your refund, it's going to cost you more later when the IRS catches what you did that was incorrect, is not good tax strategy or tax planning. So with that, the home office deduction. If you're self-employed or you have a side hustle and a dedicated space in your home where you have a home office, it's possible that you would qualify for this and you want to take this deduction to save some taxes. If you're a W-2 employee, you don't qualify for this. So I want to make sure that you don't try to take this. Pretty much everyone was working from home at some point during 2020. And so I don't want you to think that you qualify for this and then end up getting in trouble down the road for taking a deduction you shouldn't have. Best thing to do would be to go to your employer and ask for a home office stipend or potential reimbursement for some of those home office expenses that you incurred. Retirement planning. There's a lot around retirement planning. Perhaps you can defer an entire paycheck, your last one of the year, into your 401k or 403b plan. Maybe you can set up a traditional IRA and give up to the limit of $6,000 into a traditional IRA. Perhaps Roth IRA contributions are actually better for you, even though you don't get a deduction now, so you want to look into that as well. Along the lines of retirement planning is the qualified charitable distribution. For those of you receiving distributions from a retirement account right now who meet the age requirements, a qualified charitable distribution can be one of your best tax strategies. So this is where your distribution from your retirement account goes straight to the qualified charity instead of to you. It never enters into your taxable income, so you don't have to worry about whether you itemize to take a charitable deduction. So for those of you taking the standard deduction, this is the best way to get 100% deduction basically for those charitable giving, is just to do a qualified charitable distribution. Now, timing considerations are a big way in which you can strategize for taxes. Sometimes you can't get out of paying a tax through a deduction or a credit, reducing your taxes, kind of permanently. But you can affect the timing of those taxes, and this all goes to the time value of money. You would much rather me give you $1 today than 5 years from now give you that same dollar. And you would much rather pay me $1 5 years from now than give me that same dollar today. So that's the same thing here. If you have a small business and you can wait to invoice some customers until January and defer income into next year, that's a great tax strategy. If you can prepay some software subscription fees or prepay some merchandise inventory, materials, supplies, whatever you need to do here in December, that's a great way to accelerate deductions into this year. Now, you might actually want to flip those if this year was a down income year for you, because you might want to accelerate income and hold off on deductions until next year if you expect your income to be larger next year or higher than it was this year. Another thing with timing considerations gets into capital gains and losses. This goes into tax loss harvesting, and then also kind of the flip of that can be beneficial too. So if you have some taxable gains, it might be a good idea to sell some capital assets that you have current losses in order to offset those gains. If you've already sold some assets, maybe back when the market went down early this year, and you have losses, but now you have some gains, you might want to sell those assets with gains in order to utilize some of those losses. They'll just offset because you pay tax on the net gain from your capital gains and losses. With your health savings account, maybe you have a high deductible health plan, you have a health savings account. Did you maximize the contributions to that? If not, you could give more to your health savings account. With college savings, it's possible that you could set up a 529 with your state and get a state tax deduction. Now, there is no federal deduction here, but a lot of states, not all of them, but a lot of states have a deduction for 529 college saving plan. Also, if you're going to get the American Opportunity Tax Credit, if you qualify for that, you might want to go ahead and pay some spring tuition now in December to be able to accelerate that credit into this year if you haven't already maxed it out. Also, if you were affected by a natural disaster that was a federally declared disaster like forest fires or a hurricane and sometimes large storms with tornadoes, it's possible you qualify for a casualty loss deduction. So look into that as well. Moving expenses. Here's another one that I want you to be aware of. Moving expenses are no longer deductible. So if you spent them out of pocket, you no longer get a deduction for that. But you also need to know that if your employer reimbursed you or paid your moving expenses, that will be taxable compensation. So you might have higher taxable compensation than you were expecting, and I don't want you to be caught off guard with that. That could reduce your refund or even throw you into a situation where you now have to owe taxes when you do your return. So if that happened, just look a little bit more into that. Be prepared for that higher income. The Roth IRA conversion, again, this was a year where a lot of people might have experienced lower income. So it could be a great year to do a Roth conversion where you take money that's in a taxable retirement plan like 401k or a traditional IRA, you roll it over into a Roth IRA, you pay the tax now. And the reason to do that is because you think you're in a lower tax bracket now than you will be in the future, or you experienced lower income this year. It might also be a couple other reasons why that could be a good idea. So you might want to look into Roth IRA conversions if that is something that could benefit you. The Child Independent Care Credit, again, this is a credit that you can get for expenses that you incurred for a provider to take care of your child or other dependent so that you could work. If you're married, it's so that both spouses can work in order to qualify for this. You want to start thinking about this now because you need to gather a lot of information that can take a little bit of time. You need the provider's name, address, tax ID number, or social security number if it was an individual, and the amount you paid per child to that provider in order to report this and get that credit. The last thing here that I will mention is unemployment compensation. So a lot of people this year experienced unemployment and received unemployment benefits. Those are taxable benefits. So again, I don't want you to be caught off guard with having higher taxable income than what you were expecting. There is an option that they might have withheld taxes from that, which would have been a great thing to do if that wasn't the case. Again, you have taxable income there that might not have withholding on it, so that could reduce your refund or even put you in a situation where you might owe taxes when you go to prepare your return and you weren't expecting that. Now, this has been A quick rundown of those topics. You will need to, again, Google search those to look more into them, see if you qualify for them, see how to do them, how to make sure that you qualify for them before year end. If you have any questions about that, or you're concerned that maybe the Google search isn't producing qualified or quality resources where you trust that they got it right or giving you good information, feel free to reach out to me. You can go to my website. The information is below this video where you can reach out to me, connect with me, and I would love to explain more to you about these. My name is Brad. I'm with Wooten CPA. My goal here is to help you understand your taxes and help bring peace to your finance and tax responsibilities. Thanks for watching. Don't forget to subscribe and hit the bell so that you're notified when more videos like this come out. Thanks.